Hello, everyone, and welcome to this week's edition of the Vancouver Life Real Estate Podcast. And today we've got Travis Darke from the IG Wealth Management. He's a financial advisor and actually the division manager there. Travis, welcome to the show.
Thank you for having me, guys. It's a real privilege and an honor.
Yeah. I guess today, the purpose of our conversation is really to kind of get a bit of a broader look at the financial markets to kind of gain a better understanding of, the rising interest rate environment that we're seeing here, this crazy inflationary pressure, and what it means for people who are in those financial markets, what it means for maybe people who are in real estate. And I know long-term projections are very difficult to do, but at least maybe what it means in the near term for people, and what might be the best sort of path forward in this uncertain time, right?
Yeah, and understandably, we are a real estate-based information channel here, but of course there's going to be crossover. A lot of people who own or invest in real estate are going to be investing in other things. And again, like Brian touched on, having a rising interest rate environment, it's going to affect one side of the coin, but we want to hear about the other side. And that's largely why Travis is here today. We're here to talk broader markets and gain kind of a better perspective of how what you do impacts real estate. So first of all, Travis, thanks again for being here. Can you tell us a bit about yourself and how you got started and what your role with IG Wealth is?
Yeah, absolutely no problem, and pleasure to be here, like I said. It's a long story, but I'll try and keep it short because we want to hear about the broader markets, not me. But my name's Travis Darke. So I'm a division manager and a senior financial consultant at IG Wealth Management. I've been doing that for about 9 years. I actually started out of university and kind of looked around and obviously didn't know what I wanted to do. And there was a point in time in a moment of youthful indiscretion that I thought maybe I'd go to law school, but I smartened up and decided to take a stab at the investment world. And that was largely based on just the network I had around me. I had a lot of friends that were playing professional hockey and some business owners, and they all didn't really seem that clear on investments and what they should be doing with their money. And not necessarily that I knew, but I just saw an opportunity there that, there's some pretty affluent people that are still lacking a lot of clarity on what to do. And so I saw an opportunity to kind of go in there and become an expert and build a practice and kind of help guide people. So that's kind of how I got into it. And then my job at IG Wealth Management is a little bit twofold. So in one aspect, I'm a division manager overseeing kind of a team of talented financial planners, but also out there looking to bring in new talented financial advisors as well. Our company changed tremendously in the last 7 or 8 years. And so I think that message hasn't necessarily gone through to people. We kind of switched from a mutual fund manufacturer to really Canada's premier financial planning company.
Cool.
I personally oversee IROC, so we do have stocks, we have bonds, we have REITs, you name it, we can do it. So, getting that message out and letting people know that they can get, quality financial planning from an independent company. So that's kind of on the management side. And then on the consultant side, it's pretty self-explanatory. I manage a portfolio of clients, predominantly in excess wealth of $1 million per account. And that's not including real estate, so that'd be manageable assets. So that's pretty much it.
Wow. It's quite an elevator pitch. Well, let's kind of get into it. I mean, obviously, as of yesterday, there was a massive 100 basis point hike from the Bank of Canada. Obviously, in the real estate world, that's a tough pill to swallow, especially if you carry in variable mortgage rates. But volatility hasn't escaped your market either, especially in the last 6 months. In all honesty, I think probably your market was the first to move. And I kind of want to get a perspective now on what that might mean for people who do hold other investments. What are you seeing in your world with a 100 basis point hike? Yesterday my phone was ringing off the hook. Is that the same in your world?
Yeah, a little bit. It certainly shuffles the landscape, right? And that's not to say that it's necessarily a negative thing. Have I been talking to a lot of clients about it? Not particularly. really rooted in what we're doing is financial planning, and understanding that the investments are going to be what the investments are. And, we're going to get you from where you are today to where you're trying to get to down the road. We're going to do that, obviously at a risk level that you're comfortable with. And that risk level and that comfort level is entirely going to dictate your experience through those equity markets. Are people worried about it? Yeah, right. Obviously, fixed income affects everything, right? So, central bank interest rates are really the predominant metric that everyone's looking at. But at the same time, I think when your investment portfolio is rooted in a financial plan and you understand that these things are going to happen, my clients particularly haven't been too worried about it. What I'm seeing in the broader market is people are concerned about fixed income. So the bonds in their portfolio, GICs, things like this that have been locked into lower rates. And really what we're seeing for the first time in a long time is a significant pullback in the asset values of bonds. Previously, bonds used to fit into a portfolio to offer stability when equity markets would tumble. And now what we're seeing is a correlation. Equity markets are coming down and bonds are coming down as well. The reason for that is we just went through a historic and unprecedented, you got to throw that word in there now every day, unprecedented period of low fixed income rates or low interest rates, right? And I think people thought it was great because, money was practically free.
Mm-hmm.
But, as a result, now we're kind of seeing the backside or the other side of that coin, right? And it cuts both ways. But it's important to remember, interest rates rising is not new. Like, this happens all the time, right? They just maybe don't always move by 1%, right? And in fact, I think that might be the first time the BOC has ever done that. But I could be wrong on that.
Well, I also don't think, interest rates go up and down all the time. I think it's also maybe the rate at which they're going up, which is alarming people. And I also think people got used to low rates. We were sitting here for 2 years of declining rates and then bottom low rates, right? And I think a lot of people forgot that that's kind of a once in a lifetime opportunity if you're buying an asset or buying real estate or looking to loan money for next to nothing, right? Now, with people realizing that kind of the economy doesn't work on a 1% interest rate, right? It's got to be higher than that. And when you consider pension funds and that need to pay, more than 1% interest, right? In order for them to be worthwhile for people to invest in. So like you said, it's a double-edged sword. So I guess where do you see that market going from here? Is it going to continue to rise? Does it need to continue to rise in order to function better?
It's not news that the Bank of Canada doesn't want the overnight rate at 1.5%,
mm-hmm.
right? So that's something that I've certainly been telling people for a long time. It's the same thing. If the Canadian dollar is at 96 cents, they don't want it there.
Yeah.
Right. And that's what people forget is that, we're all playing in the same landscape, but there's some forces at play and they're pretty good at what they do. Which is very helpful to me and my clients because, if you kind of know what they're aiming for, right? If you're aiming for an overnight rate at 2.5%, 2%, 3%, somewhere in there to keep markets healthy. If you're looking to have your Canadian dollar at 80 cents to the US so that, our professional service exports are cheaper.
Mm-hmm.
These are things that are good and, good for Canada. And, you just have to kind of learn to live with it. And then when you know how they're going to guide policy and you kind of know what they're aiming for, you can take a certain degree of protection watching your backside, right? So, one thing that I've certainly was preaching was don't borrow more money than you can afford. Mm-hmm. And understand that the government does not want interest rates this low forever,
mm-hmm.
right? What it really took was, you have to have this inflation come in, right? Inflation is always going to be what comes into the market to really encourage the increasing of interest rates because interest rates they're your gas pedal on the economy, but they're also your brakes. And the issue that Canada kind of has, and we put ourselves in a precarious situation by allowing people to borrow so much money. I think I saw a report a couple of years ago that said it was like the most indebted nation
of any G7 nation. Yeah.
Yeah, right. And you just look at that and you're like, really? Like, because, when you're out here and you're walking down the streets, it feels pretty good on a day-to-day basis. But Canadians are swimming in debt. But because our real estate has always performed so well, people didn't seem to be too concerned about those debt loads. And now I think what you're seeing is, for the first time, they're like, oh, wow, $1.7 million is a lot of money that I owe the bank. Especially when I make $180,000 a year and our household makes $310 or whatever. And so you start doing the math and you think like, wow, that's a big portion of my income going to debt repayment. And the amount of that is increasing right now. So it's stressing people out, and rightfully so. But you kind of never should have been in that situation, right? And we saw the government and regulators trying to limit your ability to do that, right? They were going and they were saying, okay, well, you got to qualify the posted rate. Here's your lending parameters, right? We have debt service ratios to protect you. Problem is, and it happens everywhere, and this isn't a unique thing to Canada, is that people start skirting those rules, right? And so, I think if you qualified for a mortgage and you did things right and proper, I would be optimistic, right? If you went and borrowed $300,000 from your parents' line of credit and did not notify your mortgage lender that was, leveraged funds,
and you're in a world of hurt.
I'm a bit more nervous right now.
Right.
So that's just it, right? I mean, the government knows the policies; they have their finger on the pulse. But if you're kind of skirting around these layers of protection that they put in, it's probably, you might be losing a few hours of sleep each night now.
Fair enough. Okay, on the other side of that, though, if we are projected here to see further interest rate increases, what sort of basket of funds are you guys holding, or what are you advising to clients now of where they could most benefit or see the biggest returns from again, funds that, again, benefit from that type of rising interest rate environment?
Yeah, I mean, like, historically, I won't
of course.
Specific investment advice here, but historically, like, commodities are going to do well in inflationary periods, and you're already seeing that. I mean, banks do well, for not the best reasons, but they do well when interest rates are going up. So you can look at things like that, but I think really, my underlying philosophy would be to not look at necessarily the environment that you're investing in today. Take a long-term approach, right? And really, I know it just sounds like a broken record and everyone says that, but it's, go back and look at it from 30,000 feet, right? And I'm sure, you guys have told people this when they're getting real estate. Like, look, is it a better time to buy next month or last year? Like, hindsight's 20/20. Yeah, sure. But the best time to buy was yesterday.
Yeah.
Right. And then certain times in like a 12 or 13 month window, that isn't true. But at the end of the day, if you look back at it 15 years from now, and people are worried, oh, maybe I overpaid on my house a bit. Do you think it's going to be worth more or less in 15 years?
Yeah. I mean, you only have to look historically to figure that out, right? And then when you also take into effect that, Canada is looking at 450,000 permanent residents a year, then you've got international students and everything else coming in here that's largely going to, I think that's a big part of what they're hoping is going to settle some of this volatility, is by right now they're really hampering demand in that respect. But we still have a housing crisis in Canada. It didn't change overnight because of interest rates, right? And I think that's something that a lot of people tend to forget. And we often tell people, on our channel that you need to look at real estate in a minimum 5-year sort of trajectory, right? I think beyond, looking at it from a 2-year perspective, or even a lot of people, because they get caught up in hype and hysteria, they start talking about the real estate like it's a stock, right? And that's just not the case. You can't look at it that way. And I don't think you would advise that either.
No, and I think, that's just it, right? I mean, people often look at their investments the wrong way. I see it all the time, right? People come in and, oh, what can you do? And as soon as we start talking about price and performance, right? Well, what do you charge? What does your portfolio make? It's like you're already asking the wrong questions.
Interesting.
Right? And it's the same thing, right? I mean, there's going to be people that come looking for real estate. And yeah, I mean, is it important to look at like what areas have done better than other areas? Yes. But at the end of the day, I think what really sets true professional advisors like yourselves, and I would like to hope myself,
yeah, for sure,
aside from others, is we're really getting into like, well, what are you looking for here?
Mm-hmm.
Right? You want to put your kids in a good school.
Yeah.
You want to be in a nice area. Presumably you don't want a 2-hour commute. So, we have these kind of objectives, and we have these things that are going to make us happy. And that's really like the focus I take with my clients is let's try to make you as happy as possible. And then once we understand what that looks like, let's figure out how we can make the numbers look best for that, right? Because at the end of the day, like, we can bury you the wealthiest man or woman alive, or not alive, but you know what I mean. If you
wealthiest version of
ride,
yourself. Yeah.
Like, if you didn't enjoy it,
what's it all for? Yeah.
Right. So really, it's just like, let's just maximize your utility with this, understanding that, we don't want to gamble with your wealth, right? We don't want to stretch things too thin. We don't want to push the margins that if the market crashes while you're retired and you're in your withdrawal period, you're going to be euchred. We have to be prudent, but at the same time, like, you shouldn't hoard your money, right? The same way that you shouldn't necessarily live in a house that's maybe not your most comfortable because you think it's, the financially conservative thing to do.
Yeah.
Right? It's like if you can afford that house down the block, even with interest rates where they are right now, if you can afford it and it's going to make you happy and it's going to provide a great, school district for your kids, and you got that extra bedroom and your family can come from out of town and visit, like you have to look at the utility that things are going to provide you. And then let's look into the numbers, right? And at the end of the day, if it's not possible, we'll tell you that, right? We'll just say, like, look, that's going to ruin you. don't do that. But at the same time, I really think you can get bogged down in the numbers and the economics of it. But I think if you start your journey on any investment, whether it's real estate or financial, you got to look at what that investment's going to do for you personally.
I think that's a great approach, and we certainly talk to our buyers in a similar fashion, from the sense of, okay, obviously first thing to do is understand the financial capabilities and opportunities here, because we don't ever put people into homes they can't afford, because the last thing you want to do is feel house poor and not enjoy it, like you said. So yeah. One thing we'd like to explore a little bit more too, especially for the listeners here who are interested in investing through real estate. What can you tell us about REITs and the type of expectation on returns that people might be able to see through that type of investment platform?
Yeah, I mean, again, the level of expected return is entirely going to depend on what's going to happen in the future with interest rates. And to be honest, I remain optimistic. And I think that it's important to keep reiterating that to people right now, is that optimism is warranted right now. I don't see any reason to be overly concerned. I get it, right? Like COVID, war that's in the Ukraine, but it also feels like we're just tiptoeing around like World War III.
And supply chain issues. And
yeah, right? So you look at it and you're like, well, all the irons are in the fire. Right? But I would encourage people to, don't flatter today. It's not that important. This stuff's all happened in the past. Right? And so, again, it happened and we're where we are today. So, first of all, is like everyone just keep your spirits up. It might be a little bit of a rocky ride here. It's going to test our nerves, but at the end of the day, we're going to find a way to make it all work. In terms of the REITs and performance, yeah, I mean, that's one of those things where you have to be very specific about the individual type of REIT. That's going to have layers of complexity that I don't think we would have time to cover today. But again, like commercial real estate, yeah, business models are changing right now, right? You have these headwinds are not new because of interest rates, right? They were renewed because of COVID. They were expedited because of COVID. Malls had to close, and all of a sudden people were already going to online, and now the online shopping experience has become more fluid, and it's easier, and people are more comfortable with it. Commerce companies have changed their return policies to accommodate, like, look, now I order a dress shirt, I get the return label right in the box. Like, hey, if you don't like it, just send it right back.
Mm-hmm.
Right? So now I'm feeling like I got very little risk if it doesn't fit or something, right? So, these headwinds already existed. I think really what you're looking for in a REIT, if that's the right investment choice for you, is you have to look at how much of it is leveraged, right? You have to really focus on the yield. You have to focus on if that's a sustainable yield, right? REITs have, because of the nature of real estate holdings, some of them have been able to artificially increase their yields. And they've done that through, they can liquidate a property to maintain a 9% yield.
Interesting.
Well, is a 9% yield sustainable with the rents you're charging? What's your occupancy? What's your tax position? Where are you holding these, right? What's the breakdown? And it's all very, very muddy water. So when it comes to selecting the right REIT, do not focus on the yield, which is the first thing, everybody, they just look like, ooh, this one made 9.5% or whatever, right? But is it well managed? What's its track record? Is it a sustainable strategy? How are they liquidating buildings? How often are they turning over, right? Like, when you're selling a $300 million building, like there's fees associated with that, right? And when you own a $300 million building, there's maintenance. And so again, right, like, are we looking at the whole balance sheet? Are we seeing the cash flows? Are we seeing good occupancy? Do people want to be in that building? Is it office? Is it retail, right? So, is it professional services that are more like they need an office and they're going to continue to need an office? Or is it being subletted by WeWork and then subletted again to Amazon? And as soon as Amazon's head office is built, they're all going to move out.
Right.
So anytime you're making an investment, I always just say, like, just peel back the layers of the onion, right? And the nice thing about it is I think economics and finance, I don't find it overly complicated. I think it's a bit of a foreign language to a lot of people, but I really would challenge anybody to sit down and just ask some questions. If you start asking some, like, critical questions, if you start thinking, like, how do I get screwed on this? Right? What would they lie to me about? You can probably figure it out pretty quick.
Yeah. Instead of asking, what's this going to pay me? Right.
Yeah.
Start asking, what's the likelihood or the probability of this paying me?
And right on any buying decision, I mean, you just hit the nail on the head, right? It's like, don't ask there's always the first question, what's it going to pay me? What sets sophisticated investors apart from amateurs is the next 9 questions. And you already got the next one. What's the likelihood of that happening?
Right.
Right. And the question after that is, well, what would stop it? Right? In the event that it doesn't, what were the causes? Right? Instead of doing a post-mortem on how this went badly, let's do a pre-mortem and see, okay, if this goes badly for me, how is it going to happen? Right?
Smart, intelligent way of looking at it. Yeah.
Yeah. And again, that's just a risk assessment, right? And that's really all I do when I'm looking at any investment. And that's something that I think, if you're buying a house, like, that's probably an assessment you should do. Like, how does this go badly on me? Interest rates going up.
Yeah.
7%. And I do not think that's going to happen, for the record, but that should have been in everybody's analysis.
Interesting, because, when people often buy homes, even investment properties, they get really emotional about these things, right? And those sort of, how could this purchase screw me, or how could this purchase hurt me in the near term or in the long term, doesn't really come into, we advise people, right? But oftentimes we see this emotional push, right? Is that something that you get too in your investment world, or is it far more clinical, or do you help your clients be more clinical in that respect?
So I think that is kind of my unique value, is that I'm a lot more clinical about it. But really, what's interesting is about finance and kind of the area that I operate in. there's a difference, right? I mean, human beings, we make decisions emotionally,
Mm-hmm.
right? But we're making logical, things that, analytical
Mathematical decisions.
Yeah, exactly. We're doing it on emotion, and they don't line up. So really, my position, and I think my ability, is that I'm able to approach things with a technical and clinical assessment, but I'm able to communicate that to a client in the emotional way, right? So getting people to make the right decisions is, I think, anything, and I don't mean to make it sound manipulative. It's just, imagine a doctor. Someone goes in, they're like, well, I feel like crap, and blah, blah, blah. And they ask you a few questions, and they're like, well, right, but you're 80 pounds overweight,
Mm-hmm.
you don't exercise, you smoke a pack a day, and you drink, 50 drinks on the weekend. So you know what you need to do to feel better.
Right.
But then you go back to doing the same thing.
Yeah.
Right. And we're all guilty of it. So the question is, like, why isn't it? It's because they're not able to, a doctor doesn't get paid extra to get you to take good advice. They are purely paid to do it. Now, the best doctors in the world, they do get people to do it. And that's why they're the best doctors in the world. I mean, again, these are just GPs I'd more be referring to. The specialists, it's a little bit different assessment. But really, when it comes down to is getting people to take good advice is a lot different than giving good advice.
It's interesting because I think, the inflationary period that I think we're entering right now, a lot of it is like, well, if people would calm down and not spend so much, it's a psychological, emotional, human problem in many ways, right? But it sounds like to me that this is, again, more of a short-run issue that we've got, not necessarily a long-term issue. And reminding people not to make emotional panic decisions or anything to that effect right now, being more intelligent and trying to speak to people like yourself or speak to specialists in the mortgage arenas, whatever it may be, to help them make a non-emotional decision. Would you agree with that? Would you agree that inflation has that psychological and emotional effect on people?
Yeah, I mean, for sure, right? When you hear, if you don't truly understand inflation, like, you didn't study it, you don't work with it on a day-to-day basis, and all you hear is, everything's going up by 8%.
Mm-hmm.
Well, you start, you pull out your calculator, you put the price of anything in and times it by 1.08, it's going to be a bigger number.
Mm-hmm.
Right? And I think given the way that society was operating before that, people were already running that margin so close.
Mm.
So now they're thinking, like, I didn't have 8% of what I earned last year left.
Right.
That's the simple assessment. You made $100,000 last year. Pretend it was tax free. You went about your life. Did you have $8,000? If the answer to that is no, then yeah, theoretically, you'll be decreasing your lifestyle this year.
Hmm.
Right? And again, like, these are economic issues where when you put them that simple, like, let's just look at it. Let's talk about it, right? Were you in a situation historically where you retained 8% of your income?
Yeah, probably not.
Probably not.
Yeah.
But what people are forgetting is, like, it's not going to be 8%.
Yeah.
It's just not. It's 8% because we frivolously dumped, I'll say, lack of a technical term here, $1 gazillion of CERB.
Mm-hmm. Yeah.
Which really helped a lot of people. Right? So I don't want to knock it. There was people that needed some support from the government. The government stepped up.
Mm-hmm.
But they did so with complete disregard to monetary policy. In fact, I think Trudeau was on the record saying, I don't care about monetary policy.
I think you're right, yeah.
I think that's a direct quote. And now what you're seeing is the result of somebody who did not care about monetary policy. And the thing with capital markets is they're ruthless and they're unforgiving. And they do not care that the Prime Minister didn't care about it. They don't care that we overstimulated, that we don't care that we stimulated the wrong areas, right? We were giving business loans to businesses that didn't need it, right? We were giving money to people who didn't need it, right? They would have been okay. And there was tons of families who didn't qualify for CERB because they made too much money. and they were in a real hard spot.
Right.
Because they had 3 kids and daycare is egregiously expensive. And, they're at home, but they're trying to work, but they have their kids at home. And these were people that were in the real pinch. And those are the people that, I felt bad for on a day-to-day basis. So, yeah, when you put money in the wrong places and now all of a sudden everyone's feeling flush with cash and they can't travel, what do they start doing?
Buying stuff.
They start renovating their house.
Yeah. Well, and it
So
also
the price of lumber goes up, and contractors can't be found. Their contractors are booked for 2 years.
and
right?
interesting. It sounds like the Prime Minister made an emotional decision on a financial, technical thing he shouldn't have done.
Well, I'm not gonna hold it against our Prime Minister. Politicians in general, there's a fundamental issue with the way we conduct ourselves, and it's the same issue that public companies have. Is that you're supposed to be taking a long-term approach to success, but you're really just concerned about your short-term performance because really, his step one on a day-to-day basis is to try to get reelected.
Mm-hmm.
Right? So you move the needle where you can, and it's all about saving face because change is hard, it's long, it's unpleasant, and it's met with tons of pushback.
Yeah.
And when you're running on 2, 4, 6, 8-year term, no matter what it is as a politician, you're just concerned about, okay, well, I can't do anything in 2 years, right? Or I can't accomplish much in 4, right? So really what I need to do is I just need people to be feeling happy when this election rolls around and like things are okay. And that'll probably work to get reelected, right? And they're not overly concerned about addressing some of the serious issues in this country, right? And because the problem is you need 15 years. You need people to commit to you and commit to a plan for 15 years if you wanted to make a good change.
Yeah, we're all for performance-based re-election measures. That could be implemented. So, Travis, I'm envisioning 4 scenarios we're in right now, this landscape, that when you're probably having your initial consultation or meeting new potential clients, that you have a plan in place prior. So you're like, look, if things go this way, this is our plan. If things go that way, this is the plan. So that you immediately have basically a plan in place that will avoid any emotional or rash decisions. Because I think right now a lot of people, maybe they're not feeling as wealthy as they did last year. And typically maybe they're going to pull back on things like investments, where we look to Warren Buffett, for example. He's going to say do the opposite, right? Be greedy when others are fearful. What do you think people are doing that right now? And again, how does IG kind of handle situations that do radically change and in a quick manner?
Yeah, for sure. I mean, kind of down that same line of politicians, big institutions, it's tough to reposition a portfolio quickly, right? Under management, we have over $200 billion. You can't just trade $200 billion in a day. It doesn't work like that. So, it's difficult. You can increase speed by using certain trading strategies. So that would be my little plug for active management rather than passive indexing, is that you're able to move the needle a lot quicker by using some pretty intricate stuff that I won't bore your audience with. But yeah, so I mean, we certainly do. I have a call every week with our chief investment strategist. Not me personally, I'm not that important, but we have it for a large cohort of people here. And a guy I have a lot of respect for. His name's Philip Peterson, and just a really wise guy. And they're always looking at probabilities, right? So even just the other day, he's saying, okay, well, where are the earnings going to be at the end of the year for the S&P 500? And if we were to go into a recession, what would that look like, right? If inflation goes to this, what are we going to look like, right? So we're constantly forecasting different scenarios so that we can reposition things quickly. And the one thing that I will say is every reputable investment strategist I've talked to in the last 6 months is very, very optimistic. So, a key takeaway for the audience is just there's optimism amongst the people who have the most knowledge of financial markets. And yeah, I mean, we're definitely looking at it, right? Like if interest rates start to go the other way, things are looking pretty good. In terms of fixed income, I think we're probably bottomed out on as bad as it's going to get. Right. So, there's reason to be positive. Corporate earnings should be good. Again, bond yields returning to a spot where high yields paying 9%. A good corporate bond can pay 5 or 6. Like, these are good things, right? They're indicative of healthy capital markets. Problem is, so many people spend all of their money on their house,
or
that their only concern is really interest rates.
And
because
do you also feel, Travis, just sorry, I interrupt you there. Do you feel this is also because a lot of our psyche is based on this instant gratification, right? Like I see a lot of people who, you're talking about building a 15-year investment strategy, not a 2-year get rich quick pump and dump kind of situation, which is what I think a lot of people are. It's all they hear on social media. It's all they really hear about and look at. And they're all looking for that too. And I think it's important from what I'm hearing from you is that that's just not the way you make money.
No. And really when you are at this for a while, it's kind of a negative thing. And I try to be pretty upbeat, but capital markets are a zero-sum game. You want to make a buck, you got to take it from someone. And most people don't have the psyche for that. So they hire professionals to do it, as they should. And again, like I said earlier, the capital markets are unforgiving, they're ruthless, and they don't care. Right? So when you really get into it, first of all, social media, you're right. Instant gratification. Social media is a massive issue in so many different ways. One of them is keeping up with the Joneses. It's amplified that to a degree that I think nobody had imagined. Where every day you feel like you're looking at people that are wealthier than you, more beautiful than you, and you're doing all this stuff. And first of all, it's not even real. It's Photoshop. It's filtered. It's manufactured. People can record that video 9 times. They can make it sound perfect. They can, and the funny part is if you ever see somebody, you might see this great picture of somebody at the beach, and then if you're standing at that beach while they're taking the photo, it's so cringy. You're like, oh my gosh, these people are shameless. And they just complete disregard for social conduct because in their mind, Instagram is social conduct. And what it's done is it's made people feel like, I need a bigger house.
Right.
I need this. I need a fancier car. And then right next to it, you have a suggested post of somebody telling you how they traded. Let me tell you how I traded this crypto strategy, and I'm now worth this much money. And if you don't believe me, check out my Rolex. And it's like, okay, yeah, right.
Well,
I get it.
Yeah.
But for all I know, you had $10,001. And you spent your last $10,000 getting a Rolex, and then you went to Instagram and convinced everybody that because you have a Rolex, you must be a really good crypto trader.
Right.
And the crazy part is that there's so many people that are hungry for more because they're spending their life looking at Instagram instead of going out there and living it. And they bite, they nibble, and they say, oh, okay, well, whatever. It's $200 to take this guy's crypto trading course.
Right.
Right. The number one, the stat came out last year, the number one most profitable thing to sell on Instagram was a class. So what do you see every day? Classes.
Yeah. And they're largely by people who are not professional or to that degree. Right. And I think that story is very true because at the end of the day, fortunes are made over time. Right. And they're made by good decisions. If you're investing or panic selling or panic buying, you're likely going to lose more than you're ever going to win.
For sure. So I think, people, we have to be aware of it. And I think, there was a really good documentary that hit Netflix about social media in general. And I can't remember the name of it, but I would recommend everyone find it. I'm sure there's more than one, but because I think to become more clinical, to become more calculated about these things, is to really just understand that these are very, very calculated marketing machines. And they're very good at what they do. And so we have to just be a little bit more cynical in certain aspects now. We have to be a little bit more calculated. And you need to do the same thing with your investments. And I mean, you see it like it's on the back of buses now. BC Securities Commission, like if you don't understand the investment, don't make it. Right? And the question is like, I've always said, why is anybody selling you an investment? You shouldn't have to be sold on an investment. It's a very Warren Buffett-esque thing to say, but it should just make sense to you. Right? I don't think Royal Bank is going to fail. Right? They pay a 3.5% dividend. Now, because they pay a 3.5% dividend, I'm going to have to pay quite a bit more than they earned last year per share. And that's your price earnings ratio. Right? And so that's a measure that we always talk about is PE ratios, right? How much do you have to pay per $1 of earning? Right? And when you see interest rates go up, PE ratios tend to contract. To what extent? We'll have to see. But really, that's what it boils down to is a good quality technical analysis of like, what do you think this company is going to do moving forward? Will it provide us with what you need to live the life that you want to live? But stop looking at it. Like stocks don't go 9,000% unless you know something the rest of the world doesn't know, and then you're risking going to jail.
Fair enough.
It's funny, like you hear it all the time, and I just, I would say from the other end of the computer, and people are probably going to call me a boomer for this, even though I'm not a boomer, but it's just meme stocks, things going to the moon. It's not like that. Like, let's just make prudent decisions. Let's have a diversified portfolio. Let's focus on making people happy. Let's focus on making investments that feel good for you and your family. And let's focus on stuff that really, when you go to bed at night, your personal situation makes sense to you.
Perfect. I think that might be a great place to wrap it up there, Travis. Yeah. So for our viewers and listeners that are looking for or open to a nice long-term prudent plan, what is the best way to connect with you to have a discussion?
Best way is probably just by email, travis.darke@ig.ca. And yeah, I mean, if anybody's interested in kind of getting some clarity, that's really what we're in the business of. And I think we have a good philosophy, and we're just really looking for like-minded people that, that believe in what we do. And again, they're not looking for meme stocks or crypto trading strategy.
Perfect. Awesome. Okay, Ryan, you want to wrap this one up?
Yeah. Travis, again, thanks so much for coming on the show and for providing some insight, and again, reminding people that we're not to panic right now. We have to weather a storm, prepare, lay the groundwork, come out the other end stronger than you went into it. And I think that sounds like that's very possible. Again, they just need the right guidance and the right conversations. So thanks again, Travis, and look forward to having you on here again in the future.
Yeah, amazing, guys. Thank you so much for having me.